Welcome back. I hope you had a good lunch and managed to catch up with old friends. All re-energized now for this afternoon's sessions. In the morning, you heard about the global regulators' response to the regulatory reform over this last few years, whether they've been effective in making the market safer. But one thing actually I noticed is David Wright, Ranjit, they all stress the importance of good corporate governance, and which obviously I totally agree with them, I have to. But I do agree with them because I think without good corporate governance, you can have regulatory rules and codes that thick and wouldn't make any difference, it wouldn't be effective. And you also heard about the development of the regulation of investment products. And again, you heard about the key facts statement, and that's about integrity of information. And then last but not least, you hear the long-expected discussion on market integrity and investors' protection and enforcement. And I think that panel did not disappoint. Anyway, right, back to the topic for this panel. On this session, we're going to focus on listed companies, directors, and shareholders. You heard the title of this panel is Corporate Conduct, Integrity of Information, and Responsible Board. I think there's no dispute anymore that good corporate governance bring benefits to the enterprises and the stability and the quality of the financial market overall. But what I want to stress before I pass it to panel members is that it is good corporate governance is not just disclosure. It's more than a checklist exercise. It's much, much more than that. And I think during this panel session, we're going to touch on some of the pertinent issues regarding how can you maintain and promote good corporate governance, integrity of information, and a responsible board. So let me introduce my panel speakers. On my left is Brian Ho. Brian is Executive Director of Corporate Finance at the SFC. Next to Brian is Jamie Allen. Jamie is the Secretary General of the Asian Corporate Governance Association. Next to him is Stephen Brown. Stephen is the Deputy Chairman of the Listing Committee of Hong Kong Stock Exchange. And next to him again is Kelvin Wong. Kelvin is the Chairman of the Hong Kong Institute of Directors. And last but not least, Professor Douglas Arner, who you have heard before, he's head of the Law Department of the Hong Kong University. So give them a round of applause to warm them up. Thank you. Let me start with you, Brian, since you're sitting closest to me. Okay. Perhaps you would like to highlight some of the recent initiatives in Hong Kong to promote better corporate governance and integrity of information. They've either been already implemented or being proposed. Let's share this with the audience.
Sure. Thank you, Carlson. We've had quite a busy year last year. There are a number of initiatives. The first is January, a very important big step forward. It's the statutory disclosure regime where for many years disclosure of the so-called price-sensitive information was under non-statutory listing rules. It's a big step forward. We put them in the SFO, becoming statutory. So January is the effective date. Then we have a bit of a year's observation. I'll share that with everybody. Secondly, 1st of October, another big step forward is there is a new sponsor regime. We aim to gatekeep better in IPOs in terms of amendments to the Code of Conduct, amendments to listing rules, and also to work on the legal liability. Then thirdly, which it's announced by yourself, Carlson, that we step up on corporate regulation. We want to have a specific team within the SFC so as to complete, we as SFC being the SFO regulator. And then I'll come to that in a minute. Firstly, a year of anniversary of the statutory disclosure regime. in a recent announcement, we announced some figures. We think there is improvement. The number of so-called inside information announcement increased by 52%. I know it may be it may be purely a number game. However, we do see that the quality of disclosure improved. We can't say too much improvement, but take an example. In early next year, we saw some announcement like, oh, basically this is profit by and large same as last year, so there is no inside information. But actually, there was a positive material information and a negative one. And the company took the view that the two set off. So we sort of, so that can't be right. You have to disclose both. So we start to see fewer and fewer of these sort of cases. So this is encouraging. What is more encouraging is we start to see more regular updates of trading figures, performance indicators, and things like that on a voluntary basis. So we hope that brings in the culture. It's not purely a regulation matter. So I'll keep updating the market on the observation. And then corporate regulation. One of the reasons why we are thinking that was some recent success in enforcement action against listed companies' misconduct. This is very important because absent which merely following listed companies would be closer to a repeat of what the stock exchange is doing. However, this time, there's no duplication. Stock exchange continues to be a listing rule regulator. We are the SFO regulator because we want to have a systematic, proactive approach to follow up with, hopefully, in one day when we have sufficient resources, all the listed companies. Thus, hopefully, there are two possible consequences. One is early identification of misconduct, and then hopefully there'll be early commencement of investigation. Or with some theme or project approach, hopefully we can have some analysis and recommendation on the policy front, how to tackle those problems. Obviously, we have limited resources. We have to start with a very small team. So at the very beginning, we have to work on as a kind of risk-based approach. We have worked out a list of risk identification, or you call it red flags. The common ones are like qualification of the audit report, auditor's resignation, many directors jump ship, so on and so forth. So on these bases, other than day-to-day, we review all announcements. We have a more in-depth review of once a kind of identification risk happens, then we'll go in-depth review of the company. We do look at what happened recently in terms of reforms in regulation in overseas countries. And one common feature is that Japan has just joined UK, US, Australia in stepping up shareholder engagement. We are currently working on trying to formulate some ideas and also proposals with a view to conducting a consultation to step up on, we initially call it a code for responsible owners, and which is, as a starting point, very similar to the UK stewardship code. So hopefully that generates more shareholder engagement. That is our plan for the next step. Okay. Perhaps I should stop here.
Thank you, Brian. It seems that you're quite busy for this year. Now, let me ask Kelvin to follow up on this. Wearing your hat as the chairman of the Institute of Directors, are you worried with this proactive approach that the SFC is taking? Is it going to scare more people off being independent non-executive director?
Well, definitely for some of our members are really concerned about over-regulating because suddenly they have to have an 8 million Hong Kong dollar paycheck from the board in order to serve the board. Otherwise it is a really difficult decision for any potential candidate to serve, to be agreed to serve a board as an independent non-executive director. But then I would have thought once you have discharged your responsibility in terms of the duty of care and duty of skills, which I would say, even though it is an old saying, but then when you think hard and deep into the duty of care and duty of skill, once you have exhausted your general knowledge and your skill in serving a board, when you have exhausted your quality questions, not all questions, but in quality questions, to the extent that you believe you have made the decisions based on well-informed decisions, then I would have thought you will be discharged your responsibility, no matter we talk about whatever kind of rules and regulations. So what I would have thought, pursuance of excellence as a professional director is the name of the game.
Yes. I mean, this is obviously a very important area. It's a new initiative for SFC. I think this year will be corporate conduct promotion. So I'm just wondering if any of our other panel members want to add any comments to that particular initiative. No comment means you're all in support.
I think Jamie's going to say a lot.
Okay, maybe I come to Jamie. I mean, so Jamie, do you think that all the international regulatory reforms we've been hearing this morning, is it making the market safer? Are they improving corporate governance? Are they improving the incredible information? Has enough been done?
Well, I have to confess I wasn't here this morning, so I'm suffering from
That's
a bit
why I
of a
asked
cold.
you this question.
However, looking at all the international trends and reforms over recent years, I mean, I think some of them clearly will lead to improvements, but I wanted to actually start by taking a bit of a step back and make a general comment about the consistency and direction of government and regulatory reform. From our perspective, it's very important for governments and financial regulators to have a very clear direction, a clear philosophy on corporate governance reform. What we saw before the GFC was certain governments, the UK, for example, promoting a light touch regulation, really to try and bring more business to London. Post-GFC, clearly it's gone from light touch to more heavy hand or heavy thump. In Asia over the last 15 years, we've seen government commitment to corporate governance, regulatory commitment to corporate governance reform, really moving in inverse direction to the state of the economy and market. So political will and regulatory commitment seems to go up and down depending on the state of the economy and the market. Our view is it needs to be more consistent, more stable. That sends a clearer signal to the market, sends a clearer signal to investors as to where governments are going. Because honestly, in Asia, and that's what we cover 11 markets in Asia, sometimes we don't know whether governments and regulators are genuinely committed to corporate governance reform or whether it's something that's just important after a crisis. So that's sort of just a general comment. I don't know how you get away from that. Politics clearly influences direction, philosophy of regulation, but it would be nice to see at least the securities commissions in each market having a very clear direction and actually having a lot more independence from political interference. Coming to international initiatives, what I would say is it's frankly early to say whether, probably too early to say whether a lot of the reforms post-GFC are going to improve corporate governance. But one interesting thing to look at is IFIR, which is the International Forum for Independent Audit Regulators. I'm sure you're all well aware of that body, since I'm sure you're all fascinated by audit. But clearly there was a big issue with audit around the GFC. Investors are concerned about audit quality, audit capacity, also very concerned about the quality of audit regulation and the degree to which audit regulators are independent or whether they're run by an industry body. Most of the world, most of Asia now actually has an independent audit regulator. Hong Kong was still moving towards that. We don't have it yet. We have a hybrid system. We're hoping after the government consultation this year that we will get a proper independent audit regulator. But I think that is one area, at least internationally, where there has been a genuine effort at cooperation, sharing of best practices, and a genuine drive towards improvement. And given the fundamentally important role that auditors play, I think it's going to be an area that will get a lot more focus in future.
Yeah, if I may just perhaps respond to your comment about the regulatory reform being sort of sensitive to the political economic environment. Now, I think you're absolutely right. And that makes it even more important for regulators to have a very clear mission and that you stick to your principle and you do not fluctuate with the political economic climate. Leave it to a politician, but I think the regulators should stick to their job, have a clear understanding what it is. And I'd like to say that having been in the post for a year now, that for SFC here, our goalpost is very clear. It's protection of investors and making a transparent, efficient, and quality market. To us, that is our mission, and we don't deviate from that. Then if you stick to that, it's very actually easy. It's when you start taking into consideration the political environment, the economic environment, then, you know, where do you turn? I think that becomes much more difficult to handle. Anyway, I just want to ask Stephen, because you are, have been in the industry for many, many years, and at the Asia Pacific Regional Committee meeting yesterday, one of the global fund managers commented that he said that to attract more long-term funds into the region, we need to have better corporate governance. Do you believe that better corporate governance will attract longer-term funds, or all this hot money that come in and they go out again? Does it make any difference?
I won't ask which long-term fund he was from. There's no reason why anybody in the audience should know my background, but just to fill it in, I was on the sell side actually as a stockbroker for many, many years. I should actually say many decades, but that belies my age. I actually came here in the early 80s, and just to put corporate governance in context in Hong Kong, I came out just after a major company had bought a substantial minority stake in another company, and when one of the 4 Hong Kong stock exchanges asked them to make a takeover bid, the then chairman, who has long since deceased, declined graciously, and to this day they control that company through a large minority stake. And so I think corporate governance has come a hell of a long way in Hong Kong, and I think you need to put that into perspective. And it's, as Deputy Chair of the Listing Committee, another hat I wear, I think incremental change, and we have to be responsive to the community and to the market. So I don't think we should be there imposing our views. We should be reflective and attuned to what the market requires, and that's why with the SFC, well, Hong Kong Stock Exchange ourselves, we do public consultations to try to gauge that. So I also, in my day job today, I actually see investors. I work for a major commodity company in that role for the chairman and the board, and when people are interested in commodities, I probably see 1,000 fund managers a year. When they aren't interested in commodities, I can actually probably take 28 weeks holiday a year, so I'm fairly relaxed at the moment. But my major problem when people talk about long-term investors is who are long-term investors? The average UK pension fund, on the last figures that I saw, turns its portfolio every 9 months. And I know soft dollar commissions out of the UK alone are $3 billion US. And soft dollars, for those that don't know, are how legitimately and legally you pay for your airfares, you pay for your Bloomberg terminals, and you pay for everything else as an investment house. And again, I think just as a corollary to that, I noticed a few months ago that 3 senior people at Standard Life in Scotland, who would be the doyen of long-term doer investment, pocketed £10 million as bonus and salaries. So, everybody's looked at the markets, everybody looked at the companies, everybody looked at in the investment banks, but I actually think it's about time for people to start looking at the investment institutions and where their incentives are. And we're not just talking about hedge funds and 2 and 20 funds who close when it goes below the watermark. There are very, very few long-term investors out there. And the sad news for stock markets, which was something we are aware, I think, on the listing committee, is many of those long-term investors actually go through the private equity vehicle today. So stock markets are in competition for long-term money. What you do about it and how you attract them, corporate governance has obviously got to be a part of it. Nobody's going to invest short-term, long-term in a casino market. And I do honestly think that over the last 3 decades, Hong Kong has come a hell of a long way. And we have many, many good things we see on the listing committee. Obviously, bad news hits the papers, but the standard, especially with the initiatives that the SFC's made on sponsors and price-sensitive information disclosure, the statutory backing to the listing rules, I think, is absolutely vital. And I think over the next couple of decades, that will blossom in a soft-touch approach. I don't think regulation is the answer. I think, example, I think we need a bigger pool of non-executive directors. It's got to be attractive for people to do that job. It's got to be meaningful. Audit committees, as Jamie was saying, are absolutely vital in that. But I don't from my own point of view, in my day job working for a major commodity company, I have great problems identifying who long-term investors are. We had a conference call for an hour last night with a major international investor. He doesn't own shares in the stock. Probably, if he were interested, he'd take 3 or 5%. They have the option whether they're a shareholder or not constantly, and our register changes through a cycle. So as I say, it's not easy to identify who you're trying to appeal to. I think the important thing, actually, rather than look externally all the time, is to look internally. What serves domestic investors in Hong Kong? You know, we have MPF funds, trillions, moving towards trillions of dollars. A lot of it's Hang Seng index linked. That's linked into Chinese companies in particular today. We've got to look after our own money and not necessarily just pander to this mythical long-term investor overseas who's probably running a private equity fund anyway. So I think it's not neat. It really isn't. There is no answer to it. But I do think corporate governance for our own society's sake is worth pursuing. I think ethical behavior is worth pursuing. And I think that is something that comes from within and not just from the SFC or from the listing committee or whoever it might be.
Right. So your view is that there's good corporate governance, definitely for protection of investors, quality market. The long-term funds will come, they come, but don't be too hung up about it. Anyway, right, coming back to you, I just want to ask you a question. You wearing your hat as the deputy chairman of the listing committee. Can regulators do more? Should we have more regulation? What do you think?
I'd have to ask the head of the listing division whether I could comment on that question.
No, he told me. I asked him earlier. He said you can, actually.
No, I think it is a very fine balance. You know, we see it on the listing committee. The more rules we put in, the more arguments we have about the meaning of each word, and the more guidance letters we put out, which then generate, you know, very large legal bills down the road for somebody else. And I think costs are important as well. I just don't think that you can regulate against bad apples. And we've had bad apples in the Hong Kong equity market. But actually, I think given that the proximity and the area that we operate in, our track record actually on balance is pretty damn good. And I compare it to 1 or 2 other markets around the region. We do attract good companies. As a listing committee supported by the division and certainly by the SFC, I think our view is, if I could be so presumptuous, certainly my individual view is strong and better regulation make Hong Kong a more attractive place. And certainly I've been on the listing committee twice now, first time 4 years, and I've been twice, 2 years this time. Our aim is to raise our standards, and I do mean that, whilst keeping within the contemporary context. We want to raise the standards in Hong Kong. We think raising the standards attracts better companies, and that is the way to move Hong Kong forward as a financial centre.
Right, Jamie would like to respond.
I have a question for Stephen. As you're not an official member of the listing committee, but a non-official member,
Yep.
do you think the Hong Kong Stock Exchange should be a regulator, or should it just take on its business role and give the regulatory side to these guys?
That's the old chestnut, which I know I saw somebody coming into the audience.
I have to declare, I didn't plan that question.
Jamie was on the listing committee as well, so I did see David Webb in the audience. So no,
he's still here.
I think the amazing thing when people talk to me about Shanghai and these other things, threats. Over the 6 years I've been on the listing committee, and people can only serve for a maximum of 6 years. I look around that table, and the quality and depth of experience that we have, right across from ethical investors right through to investment banks, is quite extraordinary. And we rotate people, so we have critical mass. And essentially people do it for nothing. We get paid 80,000 Hong Kong dollars a year, which we used to be able to keep until Teresa, when she was chairman, invented a charity cycle event. So we now have to give all our money away to, to a charity event because of moral suasion. So I think to get those people around the table to make commercial, market-based decisions on these grey areas, and that's what we're doing, I think it's a very, very good mechanism for it. I don't think any rule changes. We operate on the basis that we go to public consultation. I think our consultations are very even-handed, and they are not preordained. And so I just don't see where the conflicts come, to be frank. obviously the CEO of the exchange can sit on the committee, but he doesn't sit on it on his own. He sits on it with 12, 24, whatever it might be, other people. So I've never seen that, honestly, I've never seen that factor at a meeting have any influence.
Brian would like to
But
add
Stephen,
something
how
to that.
about day-to-day market practitioners sitting in the committee making policy,
Well,
which affects the day-to-day practice?
But it depends, okay? If you have a whole range of people, I just don't see where that conflict is. You know, we don't have a majority of people for an investment bank. And actually, the more interesting thing is we hardly have any brokers on it. I'm almost the only person who's owned a dealing license in Hong Kong on that committee. So we have, I think, a whole range of people. I've never, from fund managers right through, so I don't think that, you know, there's any one group that, and actually, I must say, the investment bankers, you know, so when we're going through the really detailed implications of the sponsors regime, we had one, maybe two investment bankers on that subcommittee, and their input was absolutely vital.
But Stephen, the concern is not about conflict within the listing committee, although there may be some conflict.
Sorry, I thought that was your concern.
No, it's within the stock exchange of Hong Kong, whether the business interests of a for-profit company conflict with its regulatory role.
Well,
And there does seem to be a fair bit of evidence that that is the case.
Well, where is that evidence? I know, you know, there is a case cited, if I could finish, endlessly of Tom.com. Well, you know, we're in 2014. If that's the best that commentators can do, that was a 2000 event, then it's pretty damn good. You know, if you could reel off last month, you did this, you did that, then I'd have some truck with it. But, you know, as I say, when commentators harp on about Tomgot.com, I think, hold on, my grandmother was alive then, you know?
Right,
Well,
I think
she wasn't actually, but...
I think we should move on from here.
Well, no, hold on, I want his answer.
Okay.
He asked me a question, I've asked him a question.
Okay, my answer is Alibaba.
What is
There's
it?
a clear conflict.
Pardon?
There's a clear conflict in the business side of the exchange wanting Alibaba. And
Well, the exchange...
talking about that deal as if it's, you know,
well,
definitely done.
no, I don't think the exchange has made any comment. I
But
think
there's also an issue of the enforcement. I mean, the exchange's enforcement, it's not seen as a strong enforcer. If it was a pure regulator, it could take a tougher line on enforcement, as the SFC does.
well,
So I think there's two
statutory
examples.
backing has come in, and as you know, Jamie, that actually came through the listing committee, and we very much supported the SFC taking over that role. The SFC has much, much more firepower than we do, and we're more than happy on the issues that they want to take on and toughen up to pass those on, and that's what we're doing on the sponsors regime, et cetera, et cetera, et cetera. So unless you want to really fund the listing committee and put additional resources behind it to duplicate the SFC, I think the way it's working is very well. And anything that you've read in the papers in Alibaba is complete hearsay. Much of it is misinformed hearsay. And the only comment that's been officially made by the exchange was the three-sentence comment David Graham made in November. So you're dealing in hearsay.
I think we're moving away from our main topic. Maybe I'll leave it to Jamie and Stephen to continue the debate after our
No,
panel
we're
session.
going to continue it later, but we'll let Kevin have
We'll
it.
agree to disagree.
Right now, in fact, I've got a question from the floor. I won't name the person who made that question. The question is, and I'll ask Douglas to answer this, shouldn't independent directors be elected by independent shareholders? What is the point if they serve at the pleasure of a controlling shareholder? The UK has recently recognized this problem. Douglas, what do you think?
Yes, I think that that's probably a reasonable direction, but it's, like many things, harder to achieve than it is to say. I actually wanted to come back to two quick points on this. To give Stephen a little support, dual filing has worked a lot better than most of us thought it would. It seems to have worked really quite reasonably well and has gone a long way to dealing with some of these issues. So I think that's an important point. The second one, and I want to come back to this sort of bigger topic, is on the information side. And there have been some points made about disclosure.
Yep.
And the key really is that even though other things we've discovered are important than just disclosure, disclosure really is the heart of one of the key market failures, and that is the necessary information for markets to work. So it's something that one of the most interesting things I've seen is there was an article earlier this week talking about some of the changes in the Hong Kong market. And pre-crisis, it was well known in academic circles that essentially having better regulation was a competitive advantage. But we're now seeing it in market circles. Markets are recognizing that having the lowest quality of regulation is actually a disadvantage. That actually, instead of a race to the bottom, what you need is a race to the top. But there is competition at that top about trying to figure out the best way to achieve investor protection, disclosure, et cetera. So what I think I want to come out of this as is saying that even though Hong Kong's arrangements are not necessarily the same structures followed by a number of other markets, it's working reasonably well and went through the crisis reasonably well. In the director context, and I think Kelvin will hit some of this and I'll come back to it a bit later as well, we have moved a long way, but there's still a long way to go.
Right, okay. Right, maybe this is a good point to come to Kelvin. We're talking about directors. I mean, in fact, I think as part of the question raised by the floor, the concern is what should directors be doing? What should they be doing to uphold corporate governance? How do they ensure the integrity of information? And with that backdrop, bearing in mind that in Asia, this part of the world, a lot of the companies are family controlled, then there's a question of to the effectiveness and independence of directors. It's all rolled into one. So maybe you being your head as the chairman of IOD, we'd like to make a comment, respond to that.
Yep. I've been mindful that Chairman Carlson has been keep on cornering me and labeling me as the chairman of the Hong Kong IOD rather than non-executive director of the SFC.
But you are here in your role as the chairman of IOD, not as the board commissioner.
Yes. Now, I would say it is very difficult for a company director to achieving the following. Firstly, being the value maximization, or at least if not value maximization, at least you are value seeking. In the process of seeking value, enhancing shareholders' value, it is very difficult and challenging. But then, so what? We are paid for. So that is one thing. But then whether we are paid for adequately or not, especially for the INEDs, the point is, because we have David Graham here, the remunerations of the INEDs in Hong Kong are outrageously miserable to the extent that it is almost absurd for any seasoned professional directors to be willing to serve an average board, let alone a mediocre company. So therefore, I would say it is high time. For Hong Kong IOD, we have been keep on drumming our drum loud and clear that listed companies, they should consider at least, if not raising the remunerations for INEDs, at least make it becoming a policy that the remuneration committees, they should have an annual review on directors' remunerations, including INEDs. And if they have a conclusion saying that the current salary is good enough, tell us why. When I say tell us, tell the shareholders why you believe, for example, the median annual package of 200,000 Hong is good enough for an INED who at least have to attend quarterly board meetings, quarterly audit committee meetings, etc., etc. And don't forget, last but not least, we have two watchdogs who are watching you. So therefore, the legal liabilities are huge. The other competing hypothesis on top of the value maximization is the stakeholder theory. We have so many stakeholders. On top of the equity holders, we have bondholders, bankers, we have suppliers, we have customers, we have staff, we have activists, you name it. Recently, I've been reviewing a lot of empirical research as well as some library research, suggesting that, and I agree on that in principle, that for listed companies and board members, conceptually, it makes sense for us to practice stakeholders theory, try to make a very good optimizations among various stakeholders' interests. But in reality, what about the scorecard? What about the weightings between and among equity holders and bondholders and suppliers and customers and regulators? Eventually, you will be going nowhere. And then, For those who embraces stakeholders theory, probably it is only because they can attach their own weightings to different stakeholders in accordance to their selfish agenda. So they will think about it. For listed companies, director and board members, we are always competing against these two theories, value maximization versus stakeholder optimization. Then in reality, it will be up to the board and the board members to be in charge of which way they would like to go. Last but not least, for institutional investors in Hong Kong, I always challenge them that in the rest of the world, they are very eager, aggressive, and also active in trying their very best to promote good corporate governance by attending AGM, EGM, challenging the board members regarding here and there and everywhere. Why you want to expand your business? How are you going to finance your expansion plan or whatsoever? In Hong Kong, they always shied away from attending board meetings. And to that, I would say I give them a failed instead of a pass. It is high time for institutional investors and also international shareholders activists to not to stand behind as a corporate governance supporter, but then stand in front of us, challenge board members. And I have to say, as the chairman of Hong Kong ILD, we love positive and also positive confrontational conversations. This is necessary.
Yes, Kevin. So let me ask you a question. What you see, I've noticed in Hong Kong over the last few years, when something went wrong with the company, all the INED immediately resigned. Is that right?
I would say that's an animal instinct rather than human being's instinct, because you would like to just walk away. I would say they are very stupid, because resign or not, I would say they are still liable in case they have omitted anything that with hindsight they should have done something, they should have asked something, they should have stopped something from happening. So I would say with hindsight, that do them no good. They're really stupid in that sense.
But Stephen, I noticed that we don't see INED being reprimanded by the listing committee, do we?
Well, you know, on the listing committee we have various levels. Some are public disclosure, some are private disclosures, and there's discussion obviously on the listing committee about that in itself. One of the things that we've certainly have, I think the good news is, in my experience anyway, we would have the figures, I don't have them to hand, the number of disciplinary actions that we're actually involved in raw number terms seems to be less, and that might be an indication of some better behavior because of PSI and other things. It might be. I'm not saying it necessarily is. And within that, we certainly get non-exec independent directors sitting there. One of the issues, and there are many issues that we have had at the listing committee historically, is a guy turns around and says, well, the guy, you know, I never got the accounts. You know, I don't get monthly accounts. I don't get this. I don't get that. What was I meant to know? And so we have certainly sanctioned and taken action against non-exec independent directors, but there has always been that, you know, I wasn't informed. So we have taken measures so that really that defense just falls away now. And you're either on board and you have the same responsibilities as an executive director, and if you don't get the accounts, you better resign quickly. So that's gone. So we do take disciplinary action against these people, and I think people are seeing it as an obligation and rather more serious. One of the biggest issues, I think, from a personal point of view that we have is when we get the IPOs coming and the company suddenly gets formed and it suddenly has non-exec directors appearing on board. And again, you don't want to be too prescriptive. You don't want to start regulating. You know, the market's got to regulate itself at the end of the day, and price has got to be a determinant, and a strong share price should be an incentive. But if a company has a weak non-exec board which has suddenly appeared from nowhere, I think that's, you know, as an investor, I wouldn't be too comfortable with that. But, you know, if you look at the alternative, which say, well, you've got to have a non-exec board for 2 years before IPO, you simply can't do that either. So there are some issues at the pre-IPO, actually, which I feel you know, there's no easy answer to. But we do discipline.
Right. I mean, Kelvin, I do agree with you that INED should be paid fairly, but I think with that it comes responsibility. And in fact, they play such an important role. I don't think it's sustainable to say just pay them 100,000, they come to board meeting, and when board paper is presented, ask a few questions and it gets passed. Really, those days are not sustainable. But to have diligent, hardworking, committed IT who's prepared to stand up and say, I don't agree with you, you do need to remunerate them fairly, and I will agree with that. Just perhaps on the board, I mean, Jamie, another of my pet subjects, board diversity. Do you think that will help? Do you think that will help the discussion on the board with more diversity, maybe more female? Hong Kong's got very low, I mean, it's only 10% are female, and 40% of our listed companies have no female director. Teresa, I hope you're pleased I'm saying this.
Well, I think diversity is important, but it's diversity across a broad range.
Yeah,
it's not just diversity of gender, although we certainly welcome more women on boards, don't get me wrong. Although David did do a study showing that women on boards didn't necessarily add value over a 10-year period.
They do or they do not?
They do not.
They do
the
not.
Gender is not related to performance, if I'm not misquoting
Can all the
David.
female wait outside for Jamie when they come out?
No, hit David, not me. I'm just the messenger in this.
He's a posse on the news.
But I think the key issue is you start with what does the company need, what sort of business does it have, what sort of board does it need, what range of skills does it need, what nationalities, language skills does it need, so on and so forth. And that's the diversity. And some of those people will be women, some will be men. And that's, I think, a more organic process rather than promoting gender diversity on its own. We have a range of members around the world. We asked many of them whether they felt gender diversity quotas for women were important. And the interesting response was people were against quotas in Asia at this stage. And the most vociferous were the women, actually, who were against quotas. And these are women all around the world, not just in Asia. So I think people do view diversity more from a broad-based approach.
Right, okay. Douglas, I mean, in fact, we heard Kelvin put to touch on that, is about shareholders and especially institutional investors. What role can they play? And in Hong Kong, are they playing a part in upholding corporate governance? Should they do more?
I think this is an interesting point, and I want to come back to some of the things that Stephen had mentioned, actually. And that is that it's a long-term objective to have shareholders take sort of more active roles. But we have to recognize, and the K report in the UK does a very nice job of analyzing this in the UK context, how markets have evolved. In other words, if we're looking at, say, the US or the UK, most of your market is institutional investors. A very large portion of that is index-driven. Yeah. Those investors are just investing in what's in the index. They're just sitting there. At the same time, most of the trading is taking place from a very small number of high-frequency traders. So you have this odd situation where a large percentage of your shareholders are just invested because the company's in the index. And you have a large percentage of the trading which is taking place really for nothing relating to economic fundamentals of the company. And that, I think, brings a real challenge to the legal framework, that our legal framework is often designed for a reality that ceased to exist decades ago. And I think it's something that in the context of shareholders, Hong Kong is a little bit different in that we still have a large retail presence. But even amongst those retail investors, you have an interesting division. Some of them, and we saw this with HSBC in the financial crisis, some are long-term investors. They buy and they stick forever. Others are gone as soon as the day closes on the IPO and never come back. So when you're thinking about shareholders, it's a real question of the realities of the markets versus what we think they are. And so I think it's interesting in looking at how to deal with this from a regulatory standpoint, it's almost impossible. Yeah. The first, and perhaps the only thing you can really say, is a couple of points that have, once again, have been looked at in the UK. And the first is looking at the duties and compensation of asset managers. In other words, how is their performance judged? Is it judged on the basis of short-term deviation from an index, in which case they're going to be very short-term focused, they're going to be very focused on the index, they're not terribly concerned about the companies they're actually invested in? Or is it something that is long-term compensation spread over a certain time horizon, which is going to change the incentive package and the sort of direction we've seen post-crisis going in the banking context? The second, and this is the idea of what are asset managers' duties to their clients. In other words, essentially the idea of duties that the asset manager has a duty to support the best interests of their clients. Not necessarily fiduciary duty, but at least the best interests. And that changes the direction in terms of the fee structure, the churn sorts of contexts. So when we're looking at shareholder involvement, it's one of those ideas that I think everyone agrees is nice, but is very difficult to achieve, and that often our regulatory frameworks are designed for realities that no longer exist.
Now, there is some debate about activist shareholder, whether they actually bring value to the company. Have you sort of looked into this? What's your sort of findings? And
you know, it's a difficult one because they're mixed, if you will, results on the result. But if you think about it from the overall standpoint of the function of the market, if everyone is a passive investor, if everyone is indexed, then markets are not actually functioning as markets. You need a good portion of people who are actually active, taking views to set prices and impact on governance. So regardless of whether they're successful as a general matter, they're necessary for market function.
okay. Now, I think I'm playing with fire here. I'm going to ask a very dangerous question. It wasn't in my list. I'm not supposed to ask this question. And I didn't have a drink at lunchtime. I might regret this. I'm going to ask, what do you think about A and B share? I'm going to ask each of the member, what do they think? Your personal opinion. I'm not going to answer that question for obvious conflict of interest. Just like to, I mean, this audience is selected at random. This panel speaker selected at random. This is just a rep of their view. What do they think? So maybe start with Douglas.
It depends on the market context. So in markets that have a wide range of effective options for investor protection, no problems. In markets with more limited avenues, more questionable.
Okay. Calvin, what do you think?
Well, I disagree with that. I believe that the beauty of the system has to be very simple, without any preset conditions, without any prerequisite here and everywhere, making sure that there will be nothing wrong, and then reinventing the wheel. I would say that's almost to me like a no to me. The A and B shares, dual class share or whatsoever, is in a nutshell trespassing the basic and fundamental interest of a shareholder in general. And that's not to the best interest of the company as a whole. The last night's breakout news regarding that company buying over another company, isn't it on the flip side the beauty of one share, one vote system? Because by paying a check of 1.2 billion honky, that company can take over another company. So therefore, I would say one share, one vote is the name of the game. And then last but not least, my last comment to any proposal deviating from that is that based on that noises coming out from the market regarding the so-called proposal, that almost seems to me like saying the following: believe me, rather than the system. To me, I would say that's fallacy.
Right. Now, oh, by the way, one of the conditions of this consultation is we don't argue against each other. It's just your personal view. So, Stephen, are you happy to give your view?
Yeah, I'll give my view. I think I make one or two statements of fact, actually. the listing rules of the Hong Kong Stock Exchange allow the listing committee to authorize A and B shares. It is black and white. There is an exceptional circumstance exclusion in the rules, which was introduced 26 years ago deliberately, and the listing committee has the right to receive an application for listing which included A and B shares, and the listing committee, on our legal advice, could grant that. Obviously, the SFC are also a regulator, etc., etc., etc. The second fact I would like to actually put on record, and this is where David gets itchy, is we've never received such a request. So it's a purely hypothetical question. Full stop. And that's really all I have to say. I think finally I would just say the listing committee views its role very, very much as reflecting the community's wishes. And that's the broad community. It's the guy in Shao Ki Wan. Should he be able to invest in Facebook? I don't know if it were listed in Hong Kong. It represents Jamie's views, representing how many $1 trillion of investment money. And it's striking that balance. And as people who are aware of the regulatory processes in Hong Kong in this room, and many will be, is the stock exchange has commented that we are in the process and we are looking at moving towards a public consultation on these issues. So we haven't received an application request in 26 years, and we haven't used that rule exception in 26 years. So that's the reality of the situation. And David can stop sweating now, I think.
Right. Now, I promise you, this question is not planted. None of them knew that I was going to ask this question. Neither did I. Anyway, Jamie, what do you think?
Well, you won't be surprised to hear that we're fundamentally opposed to A and B shares. We feel in a public market, they create fundamental unfairness for minority shareholders. If you entrench a management team or a controlling shareholder, something goes wrong, you're a shareholder of that company, you generally want to remove that person, you simply can't because of the A and B structure. We also feel they're unnecessary in Hong Kong. It may be technically right that the listing committee can approve A and B shares, but as Stephen says, they haven't done so for almost 30 years.
Well, we haven't been asked.
Okay, you haven't been asked.
Okay.
We feel that the fact that Hong Kong has effectively had a one share, one vote system, a one share class system for 30 years is one of the reasons why Hong Kong has strengthened its regulatory system, why international investors have come to Hong Kong, had confidence in Hong Kong. So there's a real cost and benefit if you start introducing A and B shares in Hong Kong. And the third point is it's also unnecessary in most of Asia because you have concentrated ownership. So most companies don't actually need an A and B share system. And just one final point, you can point to the US and say, well, they have dual class shares, why don't we? But as Douglas says, the US has a very different regulatory system, has class action, has much stronger disclosure, much stronger enforcement. Hong Kong isn't quite the same, so you can't just cherry pick bits and pieces and transplant.
Right. Now, Brian, obviously, as you know, he is the Executive Corporate Finance. So you can answer this question in your personal capacity, or you don't answer. It's up to you.
I want to deal with a specific point.
Are you dealing with this point in your personal capacity or?
Personal
capacity, right. Okay, now, so the reporter said this is in his personal capacity, Brian Ho, not SFC, right? Okay. Everybody heard, so if the reporter report otherwise wrong, you know they misquoted. Okay, yeah, Brian, you can answer now.
The frequent comparison with the US regulation, as picked up by Jamie, is that they have the class action. This is not new. However, one point that hasn't been picked up, at least I'm not aware of by public commentators, is the different takeover regulation philosophy.
Yeah.
It's also because of this class action. That's why, in terms of US, the takeover regulation, it's more relying on the court's decision or judgment on fiduciary duty. Where in the UK or where Hong Kong follows that, it's an entirely different concept. Say, for example, fundamentally, we have the famous mandatory offer requirement. The US doesn't. But can we say which takeover regulation is better? We cannot. But simply, there are differences as such that when we borrow an example from an overseas regulation, then we have to be extremely careful. I think this point we should pay more attention to.
Right. Okay, I have, in fact, a question from our audience. In fact, more than one submission on the same question. Brian, this question is for you. where are the women panelists?
What was the question?
I thought we have many.
Where
Now,
are the
okay,
women
I
panelists?
promise, if we're hosting another forum in the future, right, actually listen to this, I will have a female, at least 2 female panel members on my panel, right? You can hold me to it.
Many of us have a feminine side, Carlson.
Right, okay, Jamie said that. I didn't say that. Anyway, I think that was an interesting discussion, and we aired some views on the most sensitive topic, which I think should be aired. But any other comments you want to say to wrap up this? We've got 5 minutes left. Oh, Brian. Oh, Brian and then Stephen.
Yeah. Well, can I just want to make one comment.
Sure.
Before you invite me on the panel again, can you assure me you're not going to ask fastball questions?
What question?
Can you brief us on all the questions?
Oh,
you're
right,
going to ask
okay,
in
yes.
future?
Oh, I do apologize. Right.
I think Douglas raised a very good subject about the K report, and I think the report is very stimulating, raised a lot of good observations. But I asked myself, does Hong Kong have the same type of problem about short-termism? The fact that we have so many family-controlled companies, basically we don't have the typical kind of principal agency problem. Interestingly, we also don't have the high-frequency trading because one of the Western recommendations is to have a tax to be imposed. We have stamp duty on trading. And do we have hedge fund activism? I think we don't even have shareholder activism. So to what extent, Douglas, you feel that Hong Kong should borrow the experience there?
You know, I think it's something that's important if we look at the Hong Kong investor base, that particularly since the early 1990s with the addition of mainland companies, that the investor profile has changed dramatically. That the investors are now global funds investing often in mainland companies as opposed to a small number of local Hong Kong companies. And as that has happened, many of the same sorts of issues now apply. Not necessarily to the large number of local companies, but as we get more and more international companies listed, the issues become more important. Likewise, I think they become more important as we seek to enhance Hong Kong as a fund management center. That these are the sorts of issues that if we're thinking about what sort of fund management industry we want, we should be considering.
Jamie, any final comments?
Well, we've talked about corporate governance and haven't really discussed independent directors to any great extent. So I think it's a subject that often gets over-talked. I think this afternoon under-talked, but I think it is probably time. We've had 15 years of reform in Asia. Most countries require listed companies to have independent directors. The general view is independent directors aren't adding a great deal of value. They're not particularly independent. That often has a lot to do with how they're appointed, usually by the controlling shareholder. So I think we do need to step back, look at how are they nominated, how are they appointed, but then also how are they trained? Are they trained? Are they evaluated? Because that, if done well, we do believe there's a lot of anecdotal evidence, at least, to show that anyone who's been on a board knows having some really good independent advice and independent mind is incredibly effective. So stepping back and seeing how we can make the system work better, I think would be useful.
Right. So David, something for the listing committee to consider. Stephen.
I think Jamie's point's absolutely right. The other thing is audit. You talk about disclosure. Well, to be frank, most companies will look at the international accounting standards. That's the level they report to. It's very difficult for a company to justify reporting more than the minimum. So I think Jamie's point again on independent audit regulation, very, very important. And I would just encourage the accountancy profession to up the standard on the disclosures. I think, again, Hong Kong is pretty good in a number of areas with the listing rules as well. But that's a major thing. And the only other thing that I just as passing, some of this whole idea, and I'm old enough to remember Sandlin's report in Britain in the mid-70s, and it was a time of very high inflation. And it was only a very, very close debate on whether the accounting should go on to cash accounting or accruals accounting. We went the accruals route, and we then gone the mark-to-market route, and some of the distortions caused by mark-to-market accounting. I can show you a particular index in the commodity market, I won't mention it, and it spiked 40% at the end of December, and it collapsed 40% in the first 2 weeks of January, and that is obviously somebody manipulating the price, and all the companies in the world operating in that market will have had to mark their exposure to that price, whether they were short or long, and it wasn't a value, it was a price. So I think there are some big issues there, but you know, those are just thoughts, really.
Okay, thank you. Kelvin, last comment?
Okay, maybe going forward, any attempt to codifying director's duty probably is a solution. Back to 2008, there was a consultation regarding whether director's duty should be codified, but then regrettably, starting from the 3rd of March this year, when we have the new company ordinance, director's duty has become a clarification only, i.e. under the new company ordinance, there will be some clarification regarding director's duty, both including this objective and also subjective test. It will then be a mix between these two tests. I would say this is one small step forward. But then even though I have some sort of a conflict of interest speaking on behalf of directors in general, one would have thought that I have a conflict in protecting them. But then the point is to elevate director's duty, I would say, is the first and foremost important thing, because be it regulators, be it investor, long-term and short-term whatsoever, you guys are looking onto the performance of a company, which is in charge by the board members. So therefore, if there is no codifications on director's duty, then probably the only solutions that we can do is to make it becoming a rule, either the listing rule or whatsoever, that directors they have to attend certain amount of CBD program on an annual basis on specific areas, so as to increase awareness and also the skill of directors.
Okay, and Douglas, final comment.
Just a thank you to Jamie and Carlson for the off-script questions. I think in the after-lunch panel, this was brilliant in keeping everyone awake. Thank you.
Thank you very much. So can you give the members a round of applause? Thank you very much.